In this example video, I'm going to go through review exercises 3.1 through review exercise 3.6. So it's looking at different journal entries, everything from typical day-to-day transactions to adjusting entries. So in review exercise 3.1, it tells us that on May 1st, our corporation purchased inventory for $40,000 on credit. On the 15th, they sold inventory with a cost of $10,000 for $25,000 on credit. And they want us to prepare the journal entries for that transaction. So when we purchase inventory, it increases the asset by how much we have paid for it. And they told us that we paid for it on account. So that would increase our liability of accounts payable. When we go ahead and sell it, they're giving us two different values here, our cost value and our sales price. So that's indicating to us that the company is using the perpetual inventory system. Every time that we make a sale, we have to journalize two entries, one to record the sales price that we're charging our customer, the other to record the cost to us. So they said that we sold it to our customer on credit, so that means we have not received the money yet. It is a receivable to us in the amount of $25,000. And we have earned that $25,000, and therefore we have generated revenue for our business of $25,000. But that's not pure profit for us. We have a cost of goods sold of the $10,000. It cost us $10,000 to purchase the inventory that we sold for $25,000. And we reduce our asset account, the inventory account, by that $10,000. In the next one, on review exercise 3.2, it says that on January 1st, the company purchased a building by paying $85,000. The building has an estimated useful life of 40 years and an estimated residual of $5,000. So they want the two journal entries, one to record the purchase of that building and the second to record the year-end adjusting entry, which in this case would be for depreciation. So what we are buying is an asset. We are buying a building that cost us $85,000, and they said that we paid for it, so we paid for it in cash. And now we have to figure out our adjusting entry amount. So in terms of our calculation for depreciation, we're going to assume the straight line method here, and in order to do the straight line, we have to take the initial cost of the asset, the $85,000, minus any type of residual value, meaning what we think we can sell the asset for at the end of its useful life. And we divide it by its total useful life in years. So in this case, it's 40 years. We have owned the building for the entire year, so we're going to record an entire year's worth of depreciation expense. So we debit our depreciation expense for the $2,000, and we credit accumulated depreciation on our building for the $2,000. If we had only owned this building for a fraction of the year, we would have not recorded an entire year's worth of depreciation. We would have only recorded however many months that we've owned that asset. The next one is another adjusting entry. So in review exercise 3.3, they tell us that our company purchased a 1-year insurance policy by paying $5,400. And they want us to, again, prepare the journal entry for the purchase of that insurance policy, as well as any year-end adjusting entry. So when we prepay our insurance for the entire year, we have a prepaid insurance asset that is created. So we record that asset at $5,400 because it's going to provide us some sort of future benefit. That is why we get to record it as an asset. At the end of the year, we have to record the expense for how much of that insurance has in fact expired. The definition of an expense is any asset that has been used in this business. So our insurance expense is going to increase, and the asset that we're using is our prepaid insurance. Remember that every time you do an adjusting entry, there has to be a balance sheet account impacted, meaning an asset or a liability, and there has to be an income statement account impacted, meaning a revenue or an expense. In every adjusting entry, The revenue or expense are always increasing. So we're either increasing our expenses for the asset that we've used, or we're increasing our revenues for what we have earned over that period of time. So our calculation for our adjustment here, we paid in total $5,400 for 12 months of insurance coverage. And it's been, again, when you're doing adjusting entries, please make sure to pay attention to dates. So we purchased that insurance policy on July 1st. So it's all of July through all of December. So July, August, September, October, November, and all of December means that we're going to record half of that 1 year. And it's going to be for those 6 months. So in total, we're going to record $2,700 in insurance expense and reduce our asset by that same value. In review exercise 3.4, they tell us that on October 1st, our company sold land that cost $30,000 and we sold it on credit for $35,000. The buyer issued an 8% 12-month note for this amount with the interest to be paid on the maturity date. When we're talking about the maturity date, we're talking about the due date. And they want us to prepare the journal entries to record the sale of the land and any related year-end adjusting entries. So we are going to be receiving $35,000 from the person that purchased our land 1 year from now. So that becomes a notes receivable. We were issued a note, and our notes can only ever go on our books at the face value, and they can only ever come off of our books at the face value. What we are selling to that person is our land. Land is one of our only fixed assets that is not depreciated, so it went on our books at what we paid for it, so it has to come off our books at what we've paid for it. And we know that our debits and credits always have to equal. So in this case, we have a gain on the sale of land because we are selling that piece of land for $5,000 more than what we had originally paid for it. October 1st of this year is when we sold it, and we're not going to get paid that $35,000 plus the interest until the next October. So we know that under the accrual basis of accounting, we have to record our expenses and revenues when they're either incurred or when they are earned. So, for example, the end of our fiscal year being December 31st, we have in fact earned some of that interest. We're not going to receive it to the next fiscal year, but if it's earned in this fiscal year, we have to record it in this fiscal year. So our calculation for our interest, we always take our face value, which in this case is $35,000. We multiply it by the interest rate. Remember, all interest rates are expressed in annual terms. An entire year hasn't passed yet, right? So all of October, all of November, and all of December are what we've earned in this current fiscal year. So we have to multiply it by time. So we've had that note out for 3 months in this fiscal year. So that means I've earned 3 months of interest. So we have an interest receivable that we're going to record and an interest revenue. We've earned that interest by allowing the person that we sold our land to have an entire year to pay us for that land. So we've earned some of that interest in this current fiscal year. We'll earn the remaining amount in the next fiscal year. And so in total, we've earned $700. Again, adjusting entry, affecting a balance sheet account, affecting an income statement account, and your income statement account is always increasing. In review exercise 3.5, it tells us that our company rents out a portion of its building to Jerry Company for $1,000 per month. On August 1st, Jerry paid Garcia $12,000 for 1 year of rent in advance, and they want us to prepare our journal entries. So we received the cash on August 1st, and we received a full $12,000. We cannot record that as revenue as of August 1st because we haven't earned it. We don't earn revenue until we've actually provided a service or sold a customer a product. So this becomes our unearned rent. It's unearned because I've not done anything to earn it yet, so it becomes a liability. I owe Jerry $12,000 worth of renting. So we owe them 12 months of being able to rent our office facility. So on December 31st, they moved in on August 1st. So I have started to earn some of that $12,000. So when we think about our calculation here, we got $12,000 for a year. So that means we get $1,000 per month. And then I have to record how many months I've earned. So again, all of August through all of December. So we have August, September, October, November, and December. So the 5 months that have been earned. So that means we have to reduce our unearned rent by what we've earned, meaning $5,000. And we need to increase our rent revenue by the same amount. I've now earned $5,000 of the $12,000 that we received in advance. Again, adjusting entries affect a balance sheet account and an income statement account, and the income statement account is always increasing because we're always recording either what was earned during the period or what has been used or expired during that period. So revenues and expenses are always increasing with your adjusting entry. And in the last one, it tells us that on April 1st, Ringo Company borrows $20,000 from its bank by issuing a 9% 12-month note with interest to be paid on the maturity date. So again, they want us to prepare those journal entries. So in this situation, we are now borrowing. Unlike what we did back up here, where we were the one that was receiving the note and therefore in the receivable position, we are the one that's issuing the note, meaning that we're going to have to pay back that $20,000 to the bank plus that interest in a year. So what we are borrowing is we are borrowing cash, and we are borrowing $20,000 in cash, and we're signing a notes payable. And again, your notes can only ever go on your books for what you've paid for it, and it comes off your books at what you have in total. So face value and face value only. We never include interest in the note payable account. We never reduce our note payable for more or less than what that face value is. And then again, we have to do adjusting entry at the end of the period because we have incurred interest. So our interest calculation is the same as before. We take that face value of what we owe in this case, multiplied by that 9% annual interest rate, and then we multiply it by how many months have passed between when we've issued that note, which was April 1st, and when we have our year end, which is December 31st. So 9 out of 12 months have been incurred. Again, please make sure you're paying very close attention to the dates so that you're calculating your months correctly. So we have an interest expense as of December 31st of $1,350, and I owe that. So it's an interest payable of $1,350.